guys, and here we are again at economics, of course. What else would it be, right? So I'm glad to see you all here tonight, or today, or whenever you're watching it. Could be anytime, couldn't it? Okay, could be in the middle of the night for that matter. So maybe you're watching it in your sleep. Pinch yourself just to make sure. Okay. Today today is going to be a little bit more relaxed, not any graphs or anything like that. And there's some really good stuff coming up in today's. So there was a series of, in class, I usually do this in a series of smaller lectures, but I'm doing some today. So I think you'll like it. We're taking a break from graphs and stuff, and a lot of this are things that you can use in your everyday life. For example, we're going to be talking about interest rates and things of that nature. And then after this one, also there's a section on entrepreneurship, and I'm hoping that will be inspiring for you. A lot of people get inspired by that. So hope you will be one of those people. Pardon me while I adjust my chair. Okay, so you'll have that, and then also the next lesson you will have, which I will probably record, and you after this one, and you can of course watch it whenever it pleases you, will be on the stock market and corporate funding, and that's always a real good one. So for these next few sessions, it'll be that you will see a great need for in your life, and hopefully you will be able to pick up something and enjoy the process. So without further ado, we will get started. And the first one, all right, here we go. So the first thing we're going to talk about is interest in capital. All right, so interest in capital. And one thing we know about, we've talked a lot about consumer behavior. It's very important in economics. Consumer behavior kind of drives everything, as we've been talking about. So one thing we know is that our money income influences how we behave as consumers. But there's something else that influences as well, and that is time. So time influences consumer behavior by affecting your degree of consumption. All right, so time influences. Now, what do I mean by that? Well, I mean, one example is, for instance, it takes time to earn a degree. You didn't get this overnight, right? Obviously not, or you would have it by now. That's not meant to be anything ugly. That's just meant to be you would have it in one night. So it takes time to earn a degree. Otherwise, we would just all snap our fingers and have degrees. So that's the time. During that time, there is an opportunity cost involved. There's always an opportunity cost, and you've probably figured that out by now. So the opportunity cost is the foregone income and leisure during that time. All right. So we talked about how, your 3 allocations of your time, and you've got your market work, which is you receive income for. So that is something, if you're getting a degree is non-market work. So you're foregoing your market work, which is your income, and your leisure, your fun activities during that time. So that's the opportunity cost of your time, pretty much. Now the second example is if you are looking for retirement. And if you were saving for retirement, what your opportunity for that, opportunity cost there, put that here, is your foregone consumption. So if you're saving for retirement, that means you're not buying things with that money. You're putting it in the bank and saving it. Therefore, your opportunity costs are the things that you are not consuming as a result of that. There's an opportunity cost of your time with all of this, with everything that takes your time and your money. So time does influence your consumer behavior in that way. Now that leads us to another theory called the positive rate of time preference. And this is one of my favorite to discuss. And you will see why, because it gets into this behavioral economics and the psychology of it all, and it's fascinating. So I wish I were in person with you to have this discussion. But in the meanwhile, we'll just do what we do. And obviously, if you have any questions or something you want to throw out there, feel free to add them to the discussion board. And, you know, perhaps your classmates will tune in, and of course I will, and respond. Otherwise, you know, just maybe enjoy talking about it with people that you come in contact with, because I'm sure they'd love to hear about the positive rate of time preference. Let's see if we can't make it interesting, or make you as interested as I am. So positive rate of time preference tells us that people prefer to consume now rather than later, and are willing to pay more to do so. So you're preferring to consume now rather than later. You're willing to pay more to do so. The reason we know this is because people will buy on a credit card and pay interest on that. Now, sometimes I know you use credit cards for emergencies and other things like that, but if you would rather go out and eat a steak dinner tonight rather than waiting until your payday when you can afford it, you put it on your credit card. If you don't pay off your credit card, you're going to pay interest on that. You're choosing to risk. You're willing to pay that interest to have that steak dinner now instead of waiting until payday. It sounds kind of silly, doesn't it, when you say it that way? You start to say, oh, gee, I'm a big dummy for doing that. I should have just waited. But the fact is, that's subconsciously what you're thinking, even if you're not consciously agreeing to do so. Now, you're probably telling yourself, oh, I'm going to pay it off, so it doesn't matter. And I hope you do, but the majority of people don't. Otherwise, the banks would be out of business. Now, producers use this tendency to capture lost transactions. And we call these transactions consumer surplus. All right, so let's talk a little bit about consumer surplus first. Okay, and I lied to you. I'm going to draw one graph, but it's a very easy one. All right, so everybody has a price you're willing to pay for anything you buy, okay? And that price is called your marginal valuation. The price a consumer sets on each good they purchase. So it's the price, you set a price that you are willing to pay. Let's put that on there too. That they are willing to pay. There you go. All right. So it's what you're willing to pay. That's your marginal valuation. And that's kind of how you set a dollar value on your utility. You know what you're willing to pay. For example, if I go to buy a pair of jeans and I say I'm willing to pay $100 for those jeans, and I know some of you are gasping right now saying, what? But I'm throwing numbers out here, okay, just round numbers. So if I'm willing to pay $100 for those jeans, then that means I expect to get $100 worth of utility out of those jeans. Make sense? I hope so. Okay, so that's your marginal valuation. Now, when you get a price, there's an actual price on the jeans, and it may be $100, it may be less than $100. You're not going to pay more because you've already valued those jeans at $100. You're not going to pay more than that for the jeans. You're not going to exceed that valuation unless you have a jean emergency, I'm assuming. So the extra dollars, let's say that the actual price of the jeans, I'm willing to pay $100. The actual price when I go into the store is $50. So I get some extra benefit. I was willing to pay $100. I paid $50. Now I leave with $50 extra in my pocket. More than likely what I'm going to do is go and spend it on something else in the store, or figure out something. Somehow we're probably going to spend that because we've already found that, we've already got that in our mind that we're spending $100, so we're probably going to. But that extra $50 is my consumer surplus. And that is the extra dollars a consumer is willing to pay of what they did pay. And for what they did pay, I'm going to put right there actual price. All right, so above the actual price. There is a graph. We can graph this, so I'm going to draw it right over here. This is the graph. It's a very easy one. In fact, it's not even going to take up a lot of space. I'm just going to put it right over here. It's a very simple graph. And so you have your price and your quantity right there. And then we're just going to look at the demand curve. All right. So here is, this is what I'm willing to pay, and that's $100. And that is my, let's put it over here, marginal valuation right there, $100, okay? There you go. All right, now let's put the actual price on here. So that is, and that's a crooked line, but hey, what the heck, right? You're going to let me get away with that. So that is $50, okay? So $50, and that is the actual price. So there, we'll do that. So now let's look right here. This right here, this shaded area that I am kind of messily shading in, this is consumer, that's your consumer surplus, okay? This shaded area right here. I'll draw the arrow to it. There we go. So that's your consumer surplus right there. That's the extra dollars that you're willing to pay above what you did pay. Now this translates into, this becomes extra utility. All right, so this becomes extra utility, and that's a good thing. Now producers, they want to capture that. It's not necessarily, I mean, it's kind of a shady thing to do, right? But the truth is they want to capture that because they want a spot. If I come in the store and I'm willing to pay $100 for the jeans, why would they want to sell them to me for $50? If I'm happy, and they can, you know, you can view it this way. If I'm happy paying $100, then why in the world wouldn't they want to make that extra $50 off of me? Of course, the world doesn't work that way, does it? Because they don't know that I'm willing to pay $100. They do not know that. All they know is what, you know, they just have to pick a price and set it. But now there are some producers that are able to capture the consumer surplus. Okay, so some producers can capture this. So the examples, I'm going to write them and then we'll talk about them, okay? That's how I do it in the face-to-face class, so y'all can do that. All right, so some producers can capture this. Example, movie theaters and airlines are the examples that I use. So for example, movie theaters. When my family and I, my husband and I have a system. So we have some movies that we are willing to go to the theater and pay. Now, typically that's the most expensive, is to go to the theater and pay, right? Especially when you're like me, you walk in, you smell that popcorn and you lose your dang mind and have to have the big tub of it right away. So that's what I do. So it costs us a good bit to go to movies that way. We get a little bit of a student discount, or they give it to teachers too, but nevertheless, costs us a good bit. So we don't see every movie like that. You know, we see only the good movies. There are certain movies that we're willing to do that. The next level down is perhaps, used to it was buy the DVD or buy it on Amazon Prime, because I'm really loving that instead of DVDs now. So you might buy the DVD. So you're saying, okay, you know, maybe I want to, you know, that's still cheaper than going to the movies, and then we can watch it over and over again. So there's that. You can also rent it at home. If you can't wait for it to come on Netflix or something, you know, you might want to rent it on demand or on Amazon Prime or something like that. So there's that price that's a little bit cheaper, cheaper still. And then of course, some movies you don't expect them to be good. You're mildly interested in it, and so you might want to wait till it comes on Netflix or Hulu, or if you get free movies on Amazon Prime or something along those lines, or even television if you're too cheap to buy Netflix and so on and so forth. So you have those, and then the movie theaters, the movie producers, they know this, so they can price separately to capture that consumer surplus. They can decide, they can see who's willing to pay in the theater, who's willing to pay on demand, and who's not willing to pay at all. And so they can capture that consumer surplus that way. Airlines, again, anybody who buys an airline ticket at the last minute probably has to go right that minute, right? They can take advantage of business travelers that come back on Sunday. So it's a lot more expensive to fly on a Sunday than it is if you wait till Monday or Tuesday. I saw that firsthand. I was pricing a trip this past December just to go to Florida to see my daughter. I was going to fly in and out. I was trying to find one of those cheap flights. And even on the cheap flights, it would cost like an extra $20 if I came home on Sunday versus if I came home on Monday. I saved some money, and I saved even more if I came home on Tuesday. So of course I came home on Tuesday. So there are ways to do that, and depending on how much. But if you have to fly right that second, if you're a little bit flexible, if you book in advance, then you've got a little more time. And then the producers, but they're going to capture the ones who are willing to pay more, or the ones who are more rigid about their travel dates, and they capture that. So those are some examples there. Clothing is another one, full price versus waiting for sale. Some things I'll pay full price for. Yes, I know. I'm sorry. I'm a bad economist when I do that. And some things I wait for a sale. It depends. Some things just don't go on sale that you want. Okay. We know that. And then some things we know that it's going to sell out of our size, which is why the reasons why we do this. Let's see if I can write it right here. Okay. So the reasons why that we pay extra or we don't want to wait. One is that we're impatient. We might be impatient, and so we don't want to wait to get it later. And this one is an interesting one to me, is uncertainty, which is when we are afraid something will prevent future consumption. So we're afraid if we don't buy it now, we won't get to buy it at all. Either if it's clothing, perhaps we're afraid it'll sell out of the size or the color we want. Something's going to keep us from doing that. Some will come and take our money. We'll have an emergency so that we have to pay for, or something else that we have to pay for. So we don't, we're afraid that something's going to keep us from buying what we want. Therefore, we want to do it now, and we're willing to pay more to do so. Hey, we've all been there. We've all had something like that in our lives that we do so. So I find this very fascinating, because when I bet you anything, when I'm going over this, you're sitting here going, yep, I've been there. And you can think of something bought that way, that affected you. All right, so let's talk about interest. All right, so interest, and I'm going to abbreviate that with a lowercase I. So the interest rate, there are two ways that it can affect us. All right, so two ways the interest rate can affect us. One is it is money earned on savings as a percentage of the balance. Okay, so that can affect us that way. It can induce us to save. So if the interest rate increases, our savings also increases. So we want to save more if the interest rate increases. So we save more. All right, so that's one way that the interest rate can affect us. There's another way, and that is because interest is also money paid back, money paid when you borrow from the bank. money paid when you borrow from the bank. You borrow from the bank, you pay them interest. So when interest increases, borrowing decreases. So we borrow less. So we might save more and borrow less. Of course, probably today, especially as a student, you're probably borrowing more than you're saving. Nothing wrong with that. It's just the stage where you are with your life. All right, so that's two ways the interest rate influences our life, affects us. So let's look at what I like to call the anatomy of an interest rate. All right, so let's see what goes into making an interest rate. And this is where you get a little life coaching. And like I've said before, I don't charge extra for that. So this is completely free for your benefit. So just enjoy. So you start with the prime rate. Oh, I forgot I was going to start with the prime rate. All right. And the prime rate is a bank's cost of funds. Cost of funds for a bank. It is also the lowest interest a bank can charge and cover their expenses. Okay, so it's the lowest interest a bank can charge and cover their expenses. This is how much they figure out how much they have to charge you so that they can pay for, all right, first they have to pay some interest to the savers because they take the money that comes in savings and loans that out. That's where they get the money to loan you. So they have to pay whatever interest they pay for the savings. They have to charge you for that. So that's the first thing. For their salaries, all their accounting expenses, their explicit costs, all that stuff goes into the prime rate. They figure all that out, they come up with a percentage, and that's what they charge you. That is the lowest amount they can charge and cover their expenses. Now, this can be different for different banks. So if you go, and here's the life coaching part, if you are going to borrow money from the bank and you're shopping interest rates to see where you can get the best deal, you might see an advertisement say, we are loaning at prime. And that sounds great because you're like, okay, that's the lowest they can charge. That's basically their cost. That's a good deal. But every bank has a different set of expenses. So that bank's prime rate, another bank may be saying, all right, we're charging prime plus 2, but they may have a lower prime rate. So adding in the 2, it may still come out lower. So just because a bank says prime rate, don't let that marketing thing fool you. Now, definitely ask them, what is your rate? But get the actual number before you commit, because a different bank can have a different prime rate. Now, you will see also, if you happen to read the financial pages and things like that, and I hope that you do at least occasionally, you'll hear them talking about prime is up this much or prime is down. And they talk about it like there's just one prime rate. There's not. Of course, every bank has it. So what they're talking about is the Wall Street Journal prime, which is a composite. They just do an average of what most banks are charging. Now, each bank will have a different one, but they will be close. Okay, they'll be very similar. So they take those and they just come up with an average. Okay, and so when they come up with an average prime rate, then they that's what they call the Wall Street Journal prime, and they just use that as a benchmark just to see what most banks are doing. So that's what that means, and it's still good to know. So if you're thinking about borrowing money and you hear them say prime rate's up, prime rate's down, at least you will know if it's down, then more than likely it's going to be down at the bank where you want to borrow the money also. So you might want to check on that as well. So but be sure and ask what it is. All right, the second thing, then you add risk. Now, this one is what's going to really make a huge difference whether you pay a large rate or a small rate. Risk is the likelihood of repayment. So how do they think you're going to pay them back? Do they think you are likely to pay them back? If so, you are very low risk. They don't have to charge you extra. If they think that there's a good likelihood, a good chance that you're not going to pay it back, or they don't know if you're going to pay it back, perhaps you don't have a credit history and therefore they don't know what you're going to do, they may charge you extra on top of that because they want to, they want to make sure that they're going to make their money on the front end, so that if you don't pay them back, at least they have made some profit, because this money that they're loaning you is not theirs, it's the savers. So they want to make sure that they at least make some money they can cover for savers. All right. So the risk can add the biggest. Now, what will affect your risk? A couple of things. Collateral is one, if you have any collateral, and that is an item of value stand good for the loan. And if you have one, you might be less risky. So if you have an item of value that's worth a good bit of money, and you put it up as collateral, then what you're saying to the bank is, if I don't pay you back, you can take this item, sell it, and use that money to pay for my loan, to pay my debts. That is less risky. The bank they have a lower chance of losing their money. If you don't have that, if you're just borrowing on your good word, your good word doesn't help the bank if you don't have any money. And you may intend to pay them, but you don't have any money. So they make sure that they have something to cover any losses they may have. Now, you may have an item that goes down in value. For example, a car, it's collateral, they can sell it, but it goes down in value so fast and so much that it may not necessarily make your loan it may not take that much risk off the plate just to have a car. A house is different, because very rare circumstances do houses go down in value. And even in this last mortgage bubble, story for another time perhaps, but those houses, it wasn't that they went down in value, they were just overvalued in the beginning. So for example, if I tell you that that my car is worth $10,000 and it's actually worth $5,000, then my car was never really worth $10,000. It was just that's just what I stated it was worth. Okay, so just make sure so your collateral could go either way. And then the other, and this has the biggest effect on your risk, is your credit score. All right, the good old FICO. That is a record of past repayment. So they'll know, how have you paid in the past? Did you pay on time or not so much? And then if your score is higher, then that means you were less risky. All right. And anywhere in the 700s and 800s, 800 of course is the best, somewhere in the 800s. But in the 700s, that's still a good score. 600s, you're marginal, so you may have a higher interest rate. And below 600, oof, no, they consider you very risky, even if not. Now, if you have a score of 0, if you have never borrowed and paid back, you will have a score of 0. You have no credit history. That could be both good or bad, depending on the lender, because on the one hand, they don't know. You could be the best payer backer ever, or you could be very risky. You might borrow a bunch of money and never pay it back. So it's really funny. Not having any credit history can also hurt your score. I don't think that's a good enough reason to go into debt and get a lot of debt that you can't afford, but nevertheless, it is still something to consider. Okay. And then finally, the last part, well, I have two other things, and they're less important, but they still go in there, is the duration of the loan. And the duration of the loan, this means the longer term it's for equals higher interest. And that's because the longer you owe money on something, the less likely you are to pay it back. Exception being a house loan, and that's only because it's such a high amount. Or a student loan, because it's guaranteed by the government. So you can't bankrupt on a student loan. They're going to get you one way or the other on that one. So longer is a higher interest rate. And you may notice this if you're buying a car, you may go and they'll give you several options. And they'll say, okay, if you have a loan, if you have it for 3 years, 4 years, or 5 years, and you'll have different payments. And obviously the payment is higher if you pay it off in 3 years, 4 years, then 5 years is the lowest payment. Now, a lot of people look at the low payment. Okay, so they look at the low payment and that's what they choose. But if you will look at the interest rates on the 5-year loan, you are paying a higher interest rate than you are on the 3-year loan. Now, some people would say, okay, but I'll get this 5-year loan. It's a lower payment if I ever need it, but I'll pay it off quicker. I'll just pay extra payments every month. But you're still paying that higher interest. So be careful of that, okay? Just make sure, use a loan calculator, and make sure that the ultimate amount you're paying is not too much. You may be better off just to make the higher payments at the lower interest rate. And finally, the last item that can affect your interest rate is extra administrative costs and tax breaks. And I combine the last two. If you have an extra large loan, out, that could be higher interest rates because there's extra costs involved in processing that. So if you have a big loan, let's say you're buying a McDonald's franchise, and that loan is about $200,000 or $300,000. So if you're doing that, then yes, there's going to be extra costs involved in that. If you're a builder and you have a ton of construction loans, you might pay a little extra interest for that higher cost. Also, the tax breaks comes from loans to minorities, women, and local governments. Though for businesses, of course, for the minorities and women for businesses, and that equals lower interest because the bank gets the tax break and they pass that on to the consumers. All right, so have you ever heard of the term ROR? You have? Good. We won't go over that. Just kidding. I'm sure some of you at least probably haven't. All right. So R of R, it means rate of return. And you may hear a bank or a business talk about an ROR on an investment. And all they're talking about is how much money do we make based on what we spend. So if you spend, for example, you're getting a degree, right? So you get your degree and you pay a dollar amount for your degree, and then you want to see what's your rate of return on that. That would mean how much extra salary are you getting for having this degree in that field. I'll give you another example. A gentleman once rear-ended my car. So he hit my car in the rear end, which meant it was his fault. And he wanted to, instead of turning it in on insurance, he wanted to just pay me. And that's fine with me. I had a police report, so we went with that. So I looked up, I took the money, took his cash, he paid me in cash, and I looked up and I saw that if I was going to sell this car anyway. So if I got it repaired, it was going, so the bill for the repairs, mind you, was right under $1,000. So he's going to pay me $1,000. So I looked, and if I repaired the car, it would add $250 onto the price of the car that I could sell it for. But I'm getting $1,000 cash, so I would be paying $1,000 and I would only be getting $250 back. Not even enough to cover the $1,000. So the rate of return on that was very low, and I did not do it. I pocketed the $1,000 and sold it as is. That's a real life example of how this works. Okay, so for the firm, interest on their savings is the opportunity cost of buying new capital. So if they are going to hold on to their money as savings, then the opportunity cost is that they could be buying a new piece of equipment and using it, or some sort of capital, something to make money. So firms, therefore, buy new capital Remember, capital, we're talking about equipment and computers and different things like that, okay? Firms buy new capital only if they expect it to earn a higher return than other uses of their dollars. So only if you expect it to earn a higher return. So if you're going to keep your money, if your choice is to keep your money in the bank or use that money to buy a new piece of capital, you want to know how much money do you make off that capital? Is that higher than the interest rate that the bank pays you? So so the rate of return is the expected earning from capital divided by its purchase price, right? And then you would compare this to interest on savings to evaluate decisions. So if you have your rate of return is greater than interest on savings, then buy capital. So if you can put in the money in the bank and you make some money on it, but the rate of return, the earnings you would get from the capital is greater than what you get by leaving it in the bank, then obviously you're going to buy the capital. Now let's say you're borrowing, all right? So if the rate of return what if you're borrowing? Then you would want to know, is the rate of return greater than the interest rate on borrowing? And if it is, then buy the capital, because you're going to spend this amount here to borrow it, and if you're going to earn more than what you spent to borrow, then of course you want to buy the capital. You're going to make money off of that. All right, so it's just a matter of, it's just like weighing. You're going to weigh and see what you make the most money from doing. All right, so let's do entrepreneurship. Let's talk a little bit about that. And then we will call it quits on this session. And I will probably record your next one, but you can take a break if you want. All right, so I love talking about this stuff because it's a great time if you are an entrepreneur. It is so easy to start a business these days. You have all this technology at your fingertips and all this marketing media available to you for free that you can use to get your business off the ground. So it's a great time to start a business. But an entrepreneur, let's see, if you are one, you are someone who has ideas, develops your product, takes risk, and then earns your profit. All right, so all of that together gets you to the profit, and that's what you want. So a lot of people have ideas, but not everyone is willing to develop the product and take the risk. There is a risk involved with taking your product to market. And part of that risk means you might have to spend a little money to do so. Sometimes you can do things for free, especially if you're a service person. If you want to clean houses, then perhaps all you have to do, that's your own sweat involved in that, then perhaps all you do is put out a Facebook page, put up a Facebook page or put out on your social media that you're doing that, and there you go. You can do that. You can start that job without really a lot of costs involved. But let's say you need to finance ideas. When Steve Jobs started, Steve Jobs and Steve Wozniak, Steve Jobs got a big order for some of their computer motherboards, and Steve Wozniak said, "We don't have the materials for this. We can't do this. Why did you get this order? You're stressing me out, dude." And so Steve Jobs goes and he gets investors to finance to buy the materials, and he trades them a part of ownership in the company. Um, didn't work out so well for him, but let me type it and then we'll discuss. So to finance ideas in the banks and investors take a percentage of ownership and or okay, so what they did, they came to the garage, they looked at everything, they liked the idea, so they said, okay, they wanted to keep a percentage of ownership in the company. Later, they didn't think Steve Jobs was very businesslike, didn't think he knew how to run a business very well, so they ended up firing him from his own company. Not very nice, is it? So they fired him from his own company. However, the joke was on them because without his innovation, and Wozniak had left at that point, the company didn't do very well. It floundered, and they ended up going back to convince him to come back. Joke was on them because he had learned a few things in there. So it turned out this might have been a good thing for him after all. What he had learned was that he said, number one, he wanted to make sure he had at least 51% of ownership retained with him for him to come back. Second is the people who fired him wanted them gone. So he wanted them out and he would come back then. And the rest, of course, is history. You know what happens. Of course, they agreed to his terms. And I kind of like that. All right, so what constitutes ideas? All right, so one idea is you can develop new products. And those are along the lines of someone like Steve Jobs. All right, Steve Jobs developed a new product line. Levi Strauss is another one. Now, you may not think of him as being that innovative, but think about blue jeans back in the day. Laborers and farmers and all were wearing overalls with the bibs and everything. And so Levi Strauss had the idea it would be more comfortable, maybe more presentable. I'm not sure exactly what was motivating him, but said, let's take the bib off and make it a waistband and so on and so forth. My dad, who's 93, still calls them overall pants because that's what they called them during the day. And look at look at the industry that has turned into for not just Levi's, but other manufacturers that followed suit, and that all came from his idea. So that was a pretty innovative idea at the time. So just think, even something that may seem simple could turn into this whole big, huge juggernaut of an industry. You never know. All right, so you could be an entrepreneur by improving existing products or process. And who I think about with that would be Howard Schultz, CEO of Starbucks. And, another would be Walt Disney. And I don't have to tell you who he is, right? Howard Schultz, coffee still existed. Coffee had been around for 100 years, longer. So he didn't invent coffee, but he took coffee to a whole new level. Look at how coffee is done now. How many of us would have ever had a latte if Starbucks hadn't become the behemoth it was, or it would have been something, in this really small coffee shop somewhere that you would figure that out. But he took drinking coffee to a whole new level and made this incredible industry out of it. So Howard Schultz definitely improved on an existing product. Walt Disney, when he started Disneyland, he did that because he would take his daughters for the day on Saturday so that his wife could have some time to herself. And he said there was no place to take his daughters, no place for someone to take their family and just hang out and have a good time. He came up with Disneyland. Um, and that was he was very innovative his entire life. Fun fact for you about that, he had his business, his partner in there was his brother Roy. Roy was the finance guy. Roy was the economist, the numbers guy, that. Walt was the dreamer, the creative one. It was a great partnership. Most partnerships don't work as well as they did. Another fun trivia for you is that the original name of the company was Disney Brothers. And Roy was the one that said, let's just call it the Walt Disney Company because, Walt, you need to be the face of the company. You're the one, you're the creative, you're the charismatic, you're the one that gets there that people want to see. You know how to entertain people. You're the entertainer, and I'm the behind-the-scenes guy. So they called it Walt Disney. But it was great. And so you see, he definitely improved on existing products. Amusement parks, carnivals, they had been around. He made them better. And it's a fascinating person. All right, so another one. Production methods. And production methods, pardon me, we'll talk about Ray Kroc. And if you don't know who he is, founder of McDonald's, the corporation as you know it. He didn't invent McDonald's. We'll talk about that in a moment. And Henry Ford, whom you know he is. Ray Kroc, he had discovered he was selling machines to make milkshakes. And he sold some. Part of his travels, he was a traveling salesman, and his travels took him to California. And someone was, he saw somebody eating this burger that looked really good. And he said, where'd you get it? And it was at this restaurant called McDonald's. And it was owned by two brothers, the McDonald brothers. And they had come up with a production method which was what we know today as fast food. And they had everybody in their little area, and they were specializing in one thing, like you were either grilling the burger patties, you were assembling the burgers, you were making the fries, you were making the shakes, all those things, and you stayed in your spot, and when you finished, you passed your work down to the next person, and then that got to the cashier who took the orders and the money and gave the food to the individuals. And so that was fast food. They were serving a lot of burgers, and they were making money at it. They were doing quite well at it. Ray Kroc thought that was something that could be used in restaurants and that could be franchised all over the world. The McDonald brothers were hesitant about that. And then they ended up going along with it. And the story is that Ray Kroc ended up cheating out of their business, possibly so. But McDonald's, you can see it is a huge juggernaut of a business right now, and certainly that was very entrepreneurial of him to recognize, to bring it out there. And possibly, without that type of ruthless businessman, it may not have made it, or perhaps it would have. Perhaps they would have gone slower and done it anyway. Henry Ford invented the assembly line. He came up with that method of production, which has revolutionized. It made things so much faster, so much easier, and they were able to produce extra. And it made it easier on workers as well. So that was another entrepreneurial idea that worked. And finally, the last is ways of doing business. That comes from people like Michael Dell, who had a different way of doing business. You could custom order your computer and it's delivered to your front door. Very nice way of doing business. I've ordered a Dell before back in the day, and I loved it. It was a great experience. And then Lee Iacocca, whom I'm sure you guys probably haven't heard of, but you're familiar with his work. He is the man who engineered the Ford Mustang back in the 60s. He also came up with their ideas, the Lincoln. So those commercials that you see Matthew McConaughey on, he came up with that line. And he came up with that product line by he said, let's take a Ford Thunderbird and put the grill of a Rolls Royce on it and see what we get. So that was a very entrepreneurial way of thinking. He also came up, now why I've included him on ways of doing business is because he saved Chrysler from bankruptcy. And the way he did that was, in the past, auto dealers or auto manufacturers, they would just make cars. They weren't thinking about necessarily, maybe give up some thought to what the customer wanted, but they made cars, sent them out, and then just expected people to buy them. Lee Iacocca, and then the result was they had a ton of unsold cars. So he gathered all those cars together, said, we're going to gather them together and have this big tent sale. He put them under a tent. And that marketing method is still used today, too. You can see that in auto dealers. He put them in and then said, what we're going to do from now on is, after we sell all of these, we're going to send some out like that based on research and what the consumers want. And it's going to be based on what they order. Just like Michael Dell, he said, let's have them come in and tell us what they want, and we'll make it. Now, we'll use some of those preferences and make some so that if somebody doesn't want to wait, we can go ahead and sell to them. But this is going to be a different way of doing business, and it worked. So that is another way to be an entrepreneur. So being an entrepreneur doesn't always mean that you are going to, it doesn't always mean you are going to start a business or get a new product idea. There are different ways to be an entrepreneur that don't include inventing a new product. It could include, improving existing products, production methods, or maybe just a way of doing business. All right. So I am going to post online for you. Your next assignment is going to have to do with entrepreneurs. And so I'm putting that online for you, and you can check D2L for that. Meanwhile, that concludes this session. So it might have run a little bit longer than I thought it would, but maybe not. I didn't really time it. So we'll see. And the next one we'll be posting probably at the same time. Of course, take your time, and then just keep an eye on due dates for other things. Meanwhile, have a great rest of your whatever, whether it's the day, night, weekend, whenever you're watching this, and I'll see you next time.